probability scenarios. Remember, there are no certainties in trading. Zero. You don't know what the market's going to do. I don't know what the market's going to do. Nobody knows what the market's going to do. And there's a great old famous saying, I don't know who originally created it, or I don't know if anybody knows, but it's one of my favorite sayings, and it's this: the market can do anything at any time. Boy, that is a pearl of wisdom. Take that, put it on a Post-it note, create a poster, keep it on your charting platform, on your monitors, and always, 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 always have that in the forefront of your mind, that the market can do anything at any time, because it can. It can. So the best we can do is to establish some probability scenarios. And the way I do that is at each potential entry point, I ask myself one very simple question. I like to keep things simple. How many of those 5 energies are aligned? That's it. That's all I have to ask myself. And then I give each setup a score of 1 to 5 based on how many of those 5 energies are aligned. Of course, the higher the score, the higher the probability. And I liken this to taking each trade to court. I need 5 independent witnesses to establish a preponderance of the evidence. So these energies are all measuring different things. See, I don't use 2 trend indicators or 3 momentum indicators or 5 cycle indicators. I just need 1 indicator to measure each energy. And no one of these indicators are worth a hill of beans. You know, sometimes you'll hear people say, oh, I don't need indicators, I just trade pure price action. Well, you know, that does come from some wisdom in the sense that indicators, no one indicator is going to make you any money. None of them work in the sense of being profitable. What works is putting together a methodology that gives you an edge, gives you a probability scenario. And it's a combination of things. And of course, along with this also comes risk management and money management and the work on your own psychology of trading. All of this is part of a trading methodology. But when these 5 independent witnesses that are all measuring different energies, when they all say buy or they all say sell, that has significance. Any one of them, insignificant. But because all 5 of these energies are different things, when they all say buy, you've got an edge there. You've got a probability that, you know what, this market is probably, again, probability scenarios, probably going to go up. And so it's worth putting our hard-earned money at risk in order to, you know, make some money. And over a large sample of data, we do very, 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 very well. So let me just graph this out for you. Sometimes it's easier to see pictures, and especially with trading. So energy number 1 is trend. I use the 50-period simple moving average as the intermediate trend indicator. It just gives the overall direction of the market. So here we see the market's going up, and the 50 MA is angling up. Pretty much that simple. Many people say the trend is defined by higher highs and higher lows. Actually, that is the orthodox definition of trend. But I disagree with that. I mean, here we have lower high, lower low. Is that really a downtrend? No. Webster's dictionary actually defines trend this way: to extend in a general direction. Well, is the extended general direction of this market down just because we put in a lower low and a lower high? No. The extended general direction on this chart is obviously up. So trend is up. So higher highs, higher lows, lower highs, lower lows, not a good definition for trend. Does not even fit the etymological definition. So 50 MA does that very well. Energy number 2 is momentum. And momentum is really important. This is where trend traders often get messed up. In fact, a lot of trend traders, even those who make money, even those who are profitable, quite often their win-loss ratio is worse than 50-50. And one of the things that I found is that it's because they don't use momentum along with trend. So here we have higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So it looks like the trend is up. Even the 50 MA is up. But look at momentum, our momentum indicator here. We're putting in equal high, lower low, lower high. This is what I meant when I talked about strong trends and weak trends. Technically, looking at price action, higher highs, higher lows, trend is still up. But momentum is revealing something. It's pulling the curtain away behind this trend and saying, oh, but this is now a weak trend. Therefore, you should no longer trade it. So momentum is a potentially leading indicator. And we always see the 50 MA is slow. It's actually a lagging indicator. And even though it does very well with higher highs and higher lows. But the point is, as traders, we want to be ahead of the game. We want to get in before the amateurs. We want to get in before the masses. We want the masses to come in after us to continue to push price in our direction. We need that volume to come in after our trade. That's where a lot of people get messed up with volume. They're like, oh, well, when the volume comes in, then I'll trade. No. If you come in after the volume has already shown up, then you're late to the party, my friend. You are late. You want that volume to come in after you're in the trade to push the market in your direction and for you to get that big move, the big range. Momentum can help you do that. So here again, just another example of momentum being a potentially leading indicator, even before price action. Here's cycles, energy number 3. We've got our nice little cycle indicator here, measuring your highs and your lows. Cycles are the rhythm of the market. Markets don't go straight up or straight down. They kind of wiggle up or wiggle down. They give you an indication of when to buy and when to sell. And as I said before, there's only 2 dimensions on the chart, time and price. W.D. Gann actually said of those 2, time is more important than price. And yet it's interesting how few traders have any kind of timing indicator on their chart. Not interesting, foolish. But again, cycles, even though they're great and they can help you identify highs and lows, they can't be used alone because they don't indicate range, how far the market's going to move, how far the market's going to move from that high to that low or that low to that high. So you have to use it with momentum. Also, trade in the direction of trend. So that's why, again, none of these can be used by themselves. Support resistance. Here's our Fibonacci retracements. There's your high, there's your low. That's your impulse move. Now, as we talked about before, which one of these levels will hold? Is that one going to hold? Is that one going to hold? Well, this one ends up holding. But see, here's the thing. At this level, we've got a cluster. We've got that wave high, and we've got the 50, what they call Fibonacci ratio, which is not a Fibonacci ratio. And we've got our cycle indicator now saying, oh, it's time for the market to go down. Look at momentum. When price went down, look how far momentum went down and pulled away from the 0 line. When price goes up, look how little price goes back up. It barely gets above the 0 line. That means it's weak going up. Therefore, the resistance level is more likely to hold. Plus, we have a cluster, again, that high and the 50. And we have an engulfing candlestick pattern and our cycle indicator. You put that all together, and then we can say, oh, that's the level that's most likely to hold. And then finally, the 5th energy I talked about is the fractal energy. So the fractal energy, again, just means the next higher time frame. I usually use a 3-to-1 ratio. Here we have the DAX. 2-minute chart is our setup chart. So what we've got is a downtrend. 50 MA is down. Price is below it. Okay. Count our energies. Do we have support or resistance? Yeah, that's our 15 EMA. I use 15 EMA for support resistance in trending markets. That's energy number 2. Energy number 3 is your cycle high. Cycle's turned down. Energy number 4 is momentum. Momentum is below 0. So we're counting our 5 energies here, 1, 2, 3, 4. Then we go to the next time frame, and here we want to see momentum being down. Now, here's where I do this a lot differently than many traders out there. Many traders use multiple time frames, but I promised I'd share with you how I do it differently than most traders. Here's how I do it differently. Many traders, when they use multiple time frames, they'll look at the next higher time frame, and they want to trade in the direction of the trend of the longer time frame. To me, that's a mistake. And the reason it's a mistake, we already